Okay, good morning, everyone, and welcome to another Coffee Microcaps morning meeting. Good to be back on these. We had a little break there while we were planning, organising, running the Sydney conference. For anybody who joined us in Sydney a few weeks ago, thank you very much, and you'll keep an eye out on Twitter, social media. We'll be announcing the dates for our next conference early in 2024. It should be around Easter sometime just before or after, so keep an eye out for that. For anybody who doesn't know me or didn't meet me in person, my name is Mark Tobin. I'm the founder of Coffee Microcaps, and I'm just going to quickly run through a couple of intro slides, and we're going to get straight into it with our first presenter. Firstly, I'd like to thank ShareSite, our sponsor here for all of our webinars and virtual events in Coffee Microcaps. If you are looking for some software to kind of track your performance, dividends, make tax reporting time a lot easier, and please check them out. I use ShareSite myself, and it's a fabulous piece of software. Quick compliance and disclaimer slide. For anybody who's joining us for the first time, the companies you'll normally see presenting on here kind of every 2 weeks is things capped under 300 million, our definition of a microcap, in revenue and approaching cash flow break even, or indeed are profitable. We generally don't have things from the resources and biotech sectors, what I like to call industrial microcaps, which covers basically all your other sectors, financial services, industrial companies, and the like. Structure this morning's webinar, we got 2 companies presenting. Each company will have a 30-minute slot, which we roughly break down into a 20-minute preso and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function at the bottom of your screen. It just makes it easier for me to moderate the questions when we get to Q&A. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow. You can follow us pretty much on all the socials, Twitter, YouTube, as I said, for this recording, and indeed for all the other recordings. We've well over 100 presentations up there now. So if you're looking for some other microcap content, please check out the YouTube channel, LinkedIn, and I also write a free monthly newsletter that you can get on the Substack newsletter platform. First up this morning, I'm delighted to welcome for the first time Intelligent Monitoring Group, Dennison Hambling, the MD, will be joining us. And straight after Dennison's presentation, we'll be welcoming back Paul Gillespie from Smart Parking. But that's enough from me. So I'm going to stop sharing my screen. And Dennison, if I could ask you to please share your presentation, I'll let you know when it's up on screen. Yeah, I can see it now, Dennison. You can take it away, mate, whenever you're ready.
Great. Thank you very much. Thank you, everyone, for your time this morning. It's a pleasure to be with you and to have a chance to talk about Intelligent Monitoring Group. Just make sure I can skip through this. Yep, there we go. Just a disclaimer from us too. Just quickly today, really just an overview of who IMG is, I guess a little bit about our major acquisition we made recently, and then a bit of a trading update summary of where we're at. So what is IMG, or Intelligent Monitoring Group? We're the largest provider of security monitoring services in Australasia. We also do fire monitoring on behalf of Johnson Controls. We have over 180,000 security lines in Australasia. That is essentially a system with an alarm system attached to it. It's a good business. It's very recurring, cash flow focused. We have over $6.5 million a month of recurring monthly revenue with good margins. In terms of scale of the group, around 400 or so employees spread around Australasia, represented in every city across Australia, which is a strategic strength for us in delivering the service that we deliver. In terms of the board and the people involved, so there's myself. I'm a former essentially professional investor who's partnered with Peter Cannon from Black Crane. Peter and I have co-invested in things before. We are unrelated in terms of our economic interests, but we have been in places before. Rob Hilton joined us with the acquisition of Mammoth Technology Group about 12-18 months ago, and Jason Elks, who joined our board at the end of December, who's significant experience in large-scale corporate restructuring and improvement. So a small type, very aligned board to success. In terms of the journey we've had, this has been a turnaround story. So 3 years ago, Peter and I joined the board of a business called Threat Protect. Was a very small, unconsolidated group of companies in the security monitoring space. Sort of fast forward through that journey. The first year was really turning around, operational turnaround and integration, a partial recap, and then followed through into really putting the pillars in place to start to grow the business to now have us as the industry leader and looking forward, which really culminated with a really significant acquisition of ADT, which is a well-known global security brand, but we have the Australasian license effectively in August of this year. In terms of how we work, we're really, at our simplest, we're a direct provider of security services. So that occurs through ADT. So if you call ADT, we'll provide you an alarm service. We can come and install it for you, and we can monitor those alarms 24 hours a day, 365 days a year. Our heritage has come out of being a wholesale provider of monitoring services only. So the other independent members of the community, we're the largest player in the space with about 800 of about the 2,000 independent people who have vans and have little businesses who operate in your local communities who are putting alarm systems in. We do the monitoring part for them. In terms of scale, though, the direct business is by far our largest business with the ADT purchase. In terms of the corporate strategy, we're a very focused team, focused board, focused executive and focused team with a focused strategy. It's really simple, and that's to drive cash flow. So this is a cash business. We're looking to improve upon the ADT business, which was really a business bought out of a global Fortune 300 multinational that hadn't had love for a long time. I'm sure I'll get to that. Drive that cash flow to, we're saying reduce debt. We will do that, but what we really just need to do is refinance off the debt package that we have now, which we had to put in place to do the ADT acquisition. We're in a good range now for that. We just need some time in the tank to be able to, to bring the facilities to fruition and make a sensible timing decision around coming off the current facilities. But we will reduce debt. We're targeting to get down to sort of 1.5 times EBITDA through cash flow, and primarily our focus moving forward is to improve the growth trajectory, to really create this machine that can, go on to be not just the largest player as we are now, but a really dominant player and a notable player in what is an increasingly widening and interesting security services space. In terms of that clarity of the operating strategy, really there's 3 pillars to what we're doing. The first one is we have the opportunity to do something that has not happened in Australia, but has happened elsewhere in the world. We're taking that well-known brand ADT, and it is the best known brand in the industry still. And we are starting to focus that on selling self-installed security products. Now that happens widely elsewhere in the world. It's driven significant change in penetration, and we're going to reorient our residential business in that regard. We focus on recommencing commercial installations, again in the ADT business. I'll perhaps talk about this in a sec because I have more detailed slides on these points. And we're also focused on just cost, really simplification of our business. And by that, I'm really, again, focusing on ADT, which has come out of a very stream-oriented business globally with global cost allocations, and really a global scale put to what is a local business, which provides the opportunity for quite a lot of simplification to be brought to that business, which we are currently doing. To pick those 3 points off, in terms of the operating strategies I mentioned, you can see here Australia has less than 5% penetration of monitored security alarms, and it's what we've grown up with. It's what we know. You may have an alarm yourself. You may know people that do, or you may be vaguely aware of it. It's not a major thing in Australia. That was the case in the US and globally too, up to about 10 to 15 years ago. At that point, they embraced technology, principally wireless technology, which meant you no longer needed to book a technician to come to your house, to lay wire around your house, which could take you a day or 2 days, depending on your system, which was expensive and intrusive and really kept penetration, headcare penetration at a pretty stable level for a long time. You can see the embracing of that in America, the difference in penetration that's opened up. So they're now at 22.4% and growing, at a % plus a year. And again, this is monitored security solutions. This is not your Arlo camera or whatever that you buy, from Bunnings or JB Hi-Fi. They are products. What we offer is a service. So we are monitoring live your property assets and even your person, depending on what our alarm systems and the way we deliver are. So strategy number one is to bring in modern technology to do that and match that with the brand that we have. We've launched our first DIY solution since buying ADT in August. In October, we launched our first system, which you can buy now. If you call up ADT, a 20-minute phone call, it'll have it booked in and delivered to you probably within a couple of days. You can install it yourself, you're up and running. The contra to that is if you actually still want a wired system, ADT, like everybody in the industry who is short good technical people, it'll probably take you 6 weeks to 8 weeks before you'll get that solution in. So I always argue that people don't buy security systems because they just wake up and think this is a nice idea. They tend to buy them because there's a problem or something they want, and therefore that shortening of the delivery time, the speed to which of execution actually we think will drive quite a different uptake and explains the experience in America a bit. We will bring in a further system in January next year, which we're excited about, which we have talked about in our ADT acquisition presentation, CyberSense. That will be a game changer. That is a much more technologically savvy solution with a panel, a little bit more like having an iPad in your house, which is also cheaper. And so we think that's when we'll really start to move this strategy along. Second strategy is just bringing commercial back, as we call it. ADT, under its former owner, decided to get out of commercial security about 3 years ago. That was done from a global strategy point of view, not from a business sense point of view or local business sense point of view. They turned away some really large customers that were very profitable for them just because. We still look after the monitoring of a lot of these customers, so now we are re-engaging with them and bringing them back, and we're targeting to bring that business back to at least where it was under JCI in the next 3 years, and frankly that will be all the growth that we need in this business to really get us going, which by that stage we'd be fully expecting to see that penetration and home security starting to really kick through as well. I'm really happy to say that since August we've managed to attract some of the best technicians in the industry back to ADT. In commercial, this is about thousands of sensors, thousands of doors. It's more akin to access control and security. It can push into workplace monitoring, videos, productivity. It is can be a much wider thing than just what you might think of just as a security solution: alarm on, alarm off. It is a very technical thing. It's a highly skilled area, and it's really how we are looking to also bring the ADT reputation back. We want to be the Goldman Sachs of security services. It's an analogy I use, having come from finance myself and having some global experience, to indicate the quality and how we want to be known. And I'm really excited to have been able to attract back some really highly certified, qualified, experienced technicians back into the ADT fold that hasn't had that for many years now. The final strategy, as I mentioned, is just simplification. So there's a couple of key buckets we're looking at. So yes, we're actually a pretty solid and lean monitoring centre and business ourselves. Prior to the ADT acquisition, we can use that experience there and have been doing that. But we've also got the opportunity, as we come off the transitionary support we get from the former owner of ADT, who is at the moment still providing some services to us as we share some legacy systems, for some quite significant improvements in cost and efficiency to us. So we called out $4.9 million of improvements we could see from the acquisition, and we've only put 1.6 million into the 24 number, with the rest coming in 25. It's largely timing. It's just, in terms of laying out the work we've got to do, including, putting onto our own payroll systems, working up our own ERP system, which we're doing, and taking control a little bit of our back end of IT and logistics, which with the logistics we've actually done already. It just takes a little bit to flow that through the business, but really that's all we're talking about in terms of cost improvements. This has not and was not a synergy exercise. So to go back, our thesis for investors really is quite simple. It's strong cash flow. So before the costs of the deal that we did, which will fall into this financial year, unfortunately, we completed at the end of August, which was a bit of a bummer because it means we'll be looking at these transaction costs on an annualized basis this year, and we're able to put them in last year. But before the transaction costs and restructuring charges that we've allowed for, this business is a strong cash flow business. We're going to use that to deleverage and ultimately, more importantly, refinance our balance sheet. And we're going to use the improvement and these fundamental economic strengths to drive the equity value. And so we think and we see globally, this has been a highly transacted sector globally for quite some time, with private equity in and out and strategic players, I guess, coming in increasingly to target this as a 10 times multiple, EBITDA multiple type of business every day of the week. The last major transaction globally was the acquisition of Chubb by API. What was a global portfolio was back in, note sort of slightly different interest rate environment, but was done at 14 times EBITDA. And we see our business as being absolutely equal in quality, but also a much more of a platform asset in this market than you could get anywhere else. Just to update you, since the acquisition of ADT, so since that time, we've actually acquired another little business, 3,000 security lines in New Zealand, which prior to ADT would have been a big acquisition for us. That was really just happenstance. That had been on the cards for 2 years for the ADT New Zealand team, had been blocked by JCI because of this the transaction on ADT. They're locked, loaded, ready to go, and the deal that was presented to us was the most accretive acquisition we've actually made, and that includes the hugely accretive ADT deal that we did. So I thought it's a good test for that New Zealand team, which stands alone and is being run as a separate separate operation, effectively, with some sharing of corporate function across the ADT Australia and New Zealand business. A good opportunity for them to show us what they're made of. So we have done that. We will probably have those in our accounts by the end of December. We've changed the economic model. So prior to our ownership, ADT had been using CapEx to maintain their line and customer base effectively, or grow it. Nobody else in the market does that or needs to do that. So we've come in and remedied that straight away. We've put up prices for new alarm systems to market. It has required a large jump in prices from what people are used to for ADT. This is an install upfront price, not the ongoing monitoring price. We have seen volume fall that we expected to see. In fact, we thought we might stall the business for new sales for 6 months while we did this, but it would be a significantly better cash flow result for us than what was happening priorly. We're very happy that we've only seen, we initially saw a fall of only 50% on prices that were about 250% higher. So every day of the week, we're better off, and it's improving the business. And I'm actually really, I feel a little vindicated that our thesis was right there, and now we're looking to build upon that and rebuild that sales team and really get it going. And that all culminates with trading, I guess, to this point. So we are 4 months into our year, but 3 months with ADT. When we were talking about an annualized ADT result, unfortunately, we're only going to get 11 months of that this year, where we are trading ahead of our sort of annualized EBITDA target rate, and happy to be doing so. So I think I'll just conclude here. I make a point I've been making recently, I guess, just to highlight how far this company has come, but also, where I see the challenge, and I guess the challenge I put to investors. A year ago, this business, prior to ADT, had 70,000 customers. It was on track for about a $6 million pro forma EBITDA, just on. We had a $10 million market cap with a 7-cent share price, $23.5 million of debt. And we had less than a year to run on that debt. So we were looking at bearing down a refi. We had, more than 4 times net debt EBITDA, but we were trading on around that 6 times EV EBITDA at the time. Then we set our target for 2025, and around when we did the initial recap, our target was to get to 150,000 customers. In that recap, we talk a lot about the opportunity. We do talk about the opportunity in the industry. We are still a very small player. This is a very fragmented industry. There is an opportunity to create a, I believe, $1 billion type of enterprise here. The pathway to do that is relatively simple. 150,000 customers are target. We're targeting 15 million of EBITDA and getting that net debt down to 2 to 3 times. We'll fast forward a year later from when I presented in November 2022. Those numbers are where we were. We're 180,000 customers. We're actually plus 25,000 file lines as well. So we're north of 200,000 actual customers we touch. We're a $30 million plus EBITDA business, 31 million annualized plus, as I've mentioned, with trading. Business, we've got a $63 million market cap with a 26-cent share price, so we have come off our lows. I'll get to that point in a second. With net debt of $67 million, so more net debt, but we've termed it. We're very refinanceable here with a net debt EBITDA of in the low twos. We have been approached without reaching out by 2 of the 4 major banks to pursue a senior secured refinance at the right time. Due to our current debt structure and the way it is structured and the payments we have to pay, the real target sweet spot for a refi is about 18 months into new facility, which kicked in August. So, we really got our sort of line of sight and focus on that. The real point that I'd make, though, is despite the massive improvement across the board in the business, and I guess the 5 green ticks we've got below, the one thing that we haven't succeeded on is our market multiple. And so today we sit here, cheaper than we've actually ever been as a business in terms of a multiple sense, but with the best business we've ever had, with a very secure cash flow focused business, and with more opportunity today to reinvest in our business, to potentially reinvest in other businesses, and or when we're off our debt refi, as is our intention to do, to pay dividends and or buy back if we're at low prices. And so I turn that back on investors and invite people to have a really good look at us. We're, as I said at the start, we're a very focused business. We're very clear on what we've got to do. We've got the right ingredients now to make this the business we need. I think ADT was the piece that has brought this together in terms of giving us the engine now, to go on and to do some great things. So look, I'll pause there and hope that gave everyone a bit of an overview. We're fairly open. We are an open company. I'm an open and available person. Obviously, get busy day to day at different times, but we're here to build engagement and work with all of our stakeholders. Whether that's if you need a new security alarm system, or you want to talk about that, or you want to talk about the business, then please feel free to reach out.
Thanks, Dennison. I might just kick off the questions. Maybe just a first one in terms of the subscription side of the business, where you say it's like kind of most people are with you for 7 years. In terms of ratcheting up pricing or pricing power within that business, how much of a factor is that going to be in improving the profitability of that side of the business? As I'm guessing, if I remember from the old Threat Protect business, the margins look pretty good on that side, because you've got the central monitoring system. I think it was 1 in Melbourne and 1 in Sydney, but you could add in another 2,000-3,000 lines, and it didn't really move the needle on the cost base.
Exactly right. So it's a very fixed cost business. It's got a lot of operational leverage. So if we can improve value and pricing, then we can move the economics for this business north very nicely. So one of the things, I'm not from the industry, so Peter and I essentially joined the industry 3 years ago. One of the things that stood out to us was no one had actually touched price around monitoring for many, many years. Part of that, though, is because they also haven't shown value for it. So it was a really sort of dead area, and people, again, penetration's low. People are asking themselves, why would I bother with that? As we use technology and we make the case around value, there is a lot of value we can unlock for ourselves, but also by showing customers and stakeholders the value of what we do. We have put price rises through. We put a big one through IMG about a year or so ago now. We have been now trying to condition the market and customers to get used to regular price rises and take control of that narrative. So yeah, look, it's a lever. Like every business, though, you don't want to overplay it. I think what we've got to do at the same time is show value, and make people understand that this is or find new ways to unlock increased value for people. Which the beautiful thing about this story is we really just have to look overseas and see what the best people are doing and apply it here, because it's not been happening here.
Okay. Questions are flying in here ticking fast, so we'll try and squeeze them in. The first two are a little bit technical. I might take the second one first. Just a clarification on the creditors payment. Will the working capital adjustment be provided back to IMG? I'm guessing just on the completion of the ADT, perhaps, or maybe the New Zealand business. And what's the sum from the quarterly update? So I think somebody's kind of looking at the last 4C and trying to figure out, what kind of swing.
Yeah, look, I'm not sure I fully understand the question, but we're doing the final balance sheet. We're in the process of doing the final balance sheet. So one of the things we did was we got we thought we negotiated pretty sensible working capital adjustments in our deal. I mean, we got a very good deal. It was a $45 million purchase with $37 million of cash to actually buy ADT on a transaction. I should note, when it first came to market, was a $200 million deal. In terms of creditor payments, one of the things at the current time is our creditors we control the bank accounts, we approve everything, but it goes through JCI's actual teams in terms of creditors. So there is quite a lot of work that has to go on to unwind that is happening. In terms of our expected result, though, no, I think it will come out sort of broadly as we indicated, in the deal, and I'm not saying anything to suggest any different. So, working capital is working capital now. The cash flow statement of the last quarter had all the transaction costs in it. I think we called that out and noted, and so on in the go forward from there, we don't have those anymore. It's largely all in the past now.
Yeah, and then just another question: ADT US sold their fire and commercial business for 11.2 times recently. Is the point, is that a higher or lower multiple business than residential in your opinion? So I think maybe the question is around, if you've got commercial and residential, which kind of gets the higher multiple out of the two segments.
Yeah, look, well, I guess a little bit of bias in this. I find, given our business, commercial to me is more interesting because it's the easier lever, and I see better profitability and better cash flow and quicker, I guess, growth. I see less competition there, and I see a more mature market available to services. So, look, I think they're fairly similar. I mean, people view that resi business as, you've got a lot more customers paying a lot fewer dollars across that fixed cost base. It is recurring cash flow, but look, also, you've got to chase a lot more bills if they stop paying, which can make it intense in that regard. So I'm not sure there is that much different. It is interesting to note that other countries have separated these things out. That was sort of, again, what Johnson Controls themselves tried to do. And ultimately, I don't think it really works. I think, you provide security services, you build a central brand, and you leverage off that. We want to use the ADT, the quality of our commercial work to rebuild our brand, so that when residential people use us, they know that ADT is smart. They've got the best, whatever the products and services we're offering, they're the market leaders. So I think about the same would be my answer.
Yeah. And then maybe a potential customer here, question: do insurance companies recognize the value? Do they offer discounts? If you've got a monitored alarm, at your, I'm guessing this is more from a residential perspective rather than a commercial.
Sure, and look, it's a really
one, given the low penetration.
Really good. Yeah, they do. Sometimes they don't tell you. Sometimes you have to ask. Sometimes they're clear about it, sometimes they're not. So there's no uniform rule to this. I would say to you, ask your insurance company. And look, some of them are quite explicit about it. When you take your insurance, they'll say, do you have a monitored alarm? They'll sort of nod their heads. I think you have to ask them, well, what does that mean? But yes, there is value to it. What we need to figure out, and it is a challenge, it's been a challenge to this industry for a long time, we need to figure out how to highlight that to people. Like there is definitely value for you. Certainly as you go into business, as you get into SME and commercial, but also as a residential consumer, you should be getting value from having a A1 graded, which means we are operating in bunkers. That means when Optus goes down, we're still operating because we can go to Telstra, security service on your property. Your insurers should give you a discount for that.
Yeah. And well, we all know about Optus in the last few weeks, so that point is probably more relevant these days than it was 3 weeks ago. Dennison, we're going to have to leave it there because I do know we have Paul standing by down in Melbourne. So thank you very much for joining us. And yeah, hopefully we can catch up with you down the track in 2024.
Absolutely. Thanks very much for your time. Cheers.
And I would like to welcome back now Paul Gillespie, CEO of Smart Parking, to give us an update. Paul, I've got your presentation up on screen now, so you just let me know when you want to start tabbing through the slides.
No worries. Thanks, Mark. Appreciate it. Okay, good morning, everybody, and thanks for taking some time to listen to what we've got to say today. I'm actually talking through the AGM slides and just and going through the update of the last 12 months, but also the first quarter of FY24. We posted this presentation just over a week ago, but I think it's very relevant, and I think it shows really where the business has come from over the last 12 months, but also in particular, I guess what we were talking about at the AGM, but also what I want to talk about today is really where the business is going. And also we're on to our next stage, or our second phase of growth, which we're really excited about. So like I said, we're talking through the AGM slides. I say we'll also talk about the important inflection point in our growth trajectory. And after that, of course, I'll be happy to answer some questions. So if we can go to slide 2, please, Mark. That's great. Thank you.
10-year track record. Yeah, got it up.
Lovely. Okay, so as our record FY23 results demonstrate, we have a proven technology advantage, a strong business model, and a compelling value proposition for parking site owners, property agents, and retailers. Our value add is, through the use of our proprietary technology, we increase compliance, revenue, and customer experience for our clients. We've also demonstrated over the last 12 months that we can scale profitably in multiple international markets. The disciplined execution of our growth strategies has enabled us to report 119% growth in revenues since we effectively started SPZ as a technology-driven parking management company back in 2013. Back then, almost all of our revenue, as you can see on this slide, came from the UK. Now around 20% of our revenues come from the new territories we've started to operate in the last 2 years. And over the last 10 years, we have improved net profit from a loss of $4.5 million to a profit last year of over $6 million, with record EBITDA margins in the last results. We have a proven ability to leverage our proprietary market-leading technology, a deep domain experience, and an operating model into new markets to build a successful and profitable business. Given this track record, Smart Parking is today at an exciting inflection point. We're accelerating our ambition, and we're now ready for the next stage of international expansion. With our first stage of expansion outside of the UK now building scale in New Zealand and Germany in particular, we are beginning to assess a greater range of new suitable geographies to expand into, which I'll talk more on that point later in the deck. We can go to slide 3 now, please, Mark.
Yep.
So if we look at this slide here, in FY23, we strengthened the foundations for SPZ to take the next stage of growth, and we delivered record results. Despite the macro challenges and volatility, we stayed focused on executing our growth strategy, and we finished the year with a much stronger, larger, and more profitable business. We delivered over $45 million of revenue with growth of 21%. Our core UK business performed well. We're building a good, profitable business in New Zealand, and we built the foundations for growth in Germany. Adjusted EBITDA increased by 35% to $11.5 million. We managed costs carefully to drive operating leverage, and expanded EBITDA margins by 266 basis points to 25.5%. This includes the startup costs we've invested in Germany. In constant currency, net profit after tax was $6.6 million, representing a six-fold increase on the $1 million reported for the prior comparative period. We are a growing, profitable, cash flow positive business with a strong balance sheet. At the 30th of June, we had cash on the balance sheet of over $10 million. With our financial strength, we can also fund our organic growth profile, technology investments, and complementary acquisition opportunities. We generated free cash flow of $8.7 million in the year. We spent $800,000 on the share buyback, acquiring 3.3 million shares at an average price of 23 cents. Growth CapEx was $5.7 million, on which we expect to generate a payback of 6 to 8 months on new sites. Given this momentum, we are today announcing that we're accelerating our 1,500 site organic growth target to December 2024, which is 6 months ahead of schedule. So in a world full of macro challenges and risks, what gives us the confidence to upgrade our ambition? Well, organic growth in the UK continues. New territories are making a solid contribution, and we feel we're still at the early stages of penetrating our addressable market of over 140,000 available sites. On slide 4, we can see that FY23 is a year we truly became a multi-territory business and a stronger business for it. So let me take you through the scorecard by region. We started FY23 with 839 ANPR sites under management across the group and added a net 273 in the year. That's a lift of 33%. We've now grown sites by over 30% CAGR over the last 5 years. For the group overall, PBNs increased by 29% versus the PCP. We averaged over 175,000 PBNs per quarter, with APAC and Germany providing growing contributions to the total. The UK, which is our largest business, delivered strong growth. Revenues improved by 13% to 36.4 million. Sites increased by 18% to 930, and PBNs were up 15% on the PCP. These numbers are good because we have the best-in-class technology, a value proposition that is highly attractive to our customer base, and a sales force that is proving highly effective. Whilst we're talking about the UK, I want to give shareholders and obviously people on this call a brief update on the proposed new code of practice for the private parking industry. At the full year presentations, I told shareholders and people attending the meeting that we are submitting evidence to the UK government to assist them in their decision making and also highlighting the flaws in their previous thinking. I'm pleased to say that we and the wider industry submitted a strong portfolio of evidence early in October that clearly demonstrates why there is a need for an effective deterrent in private car parks. The data submitted shows that by lowering the deterrent or the value of a parking breach notice, there will be an increase in the number of PBNs issued, which is against what the government wants to see. Since we've submitted the evidence, there has been good and positive dialogue with the government department, and we expect this to continue. However, the government have highlighted that due to the amount of data submitted from the industry, they will not be in a position to publish a new code for 6 months. With that in mind, I don't expect to hear anything until March of 2024. We move on now to New Zealand. This territory is developing into a great business for us and an attractive market. We closed the year with 84 sites under management. That's a 3 times increase on the prior period. PBNs increased by over 250%, and revenue was approaching $3 million. As well as having a consistent and constructive regulatory framework with high-performing sites, it's probably the best example of our value add and the step change we can bring to the industry. We are replacing manual systems with technology that provides data analytics and real-time customer insights. Australia, in particular Queensland, has been frustrating for us. Since we started there in July of 2021, we built an estate of 71 sites. We were generating annualized revenues of around $1.4 million. Disappointingly, these ANPR sites have not contributed any revenue since February earlier this year, when the Queensland government interrupted operations and flagged a potential change to the regulatory environment. We have had to reduce the headcounts and costs as a direct result. We are continuing to consult with the government and look forward to finding an acceptable resolution. Germany, on the other hand, is a growing success story. Since our first sites went live in March of 2022, at the 30th of June, we had 27 productive sites and a good pipeline of new opportunities. We've hired the leadership, the sales people, operations, and built our supply chain. The speed of rollout is broadly in line with our most profitable startup, New Zealand. We're focusing on signing enterprise clients to accelerate our scale. The recent $2 million acquisition of Park Innovation is a good clean fit with our footprint. Integration is complete, and we expect to convert the suitable manually operated sites to the number plate recognition operations in 2024. So in conclusion, we've made good progress delivering growth and building scale across multiple markets. Plus, we've expanded our addressable market to over 140,000 sites where we can deliver our technology and services. With 1,112 sites at the end of the year, we have a huge organic opportunity to continue this growth trajectory. Of course, as we grow the number of sites under management, our revenue and earnings will also grow significantly from where we are today. We can turn now to slide 5, please, Mark.
Yep.
Some of you may remember this slide from last year or from other presentations I've given. It highlights the 3 drivers that underpin our success and will help us grow our business into the future. The first one being organic growth in our existing operating territories. This will be driven by a disciplined sales approach of winning new locations and delivering great customer service to our client base. The second point is new markets. With our success in New Zealand and Germany, we are now busy looking for new markets where we can leverage our IP and market-leading scalable technology. Whilst expansion to new markets does cost money, it's a cost we can manage and fund from existing cash flow, and the returns on capital are attractive. And the third point is M&A. We've demonstrated with a series of acquisitions that we can find, evaluate, execute, and integrate M&A opportunities. We will continue to build the pipeline and maintain a disciplined approach, ensuring we look at deals that will be the right strategic fit and deliver a return for shareholders. We now look at slide 7 and go to our, next slide, please, Mark. Thank you. And the Q1 FY24 metrics and our trading performance for the first quarter. As you can see, SPZ is trading well. We've maintained our strong exit run rate from FY23 and the growth is continuing. While Q1 is a seasonally strong quarter with the peak of the Northern Hemisphere holiday season increasing foot traffic, we have delivered robust growth versus the prior corresponding period. Revenues for Q1 are up 25% compared to the PCP. Adjusted EBITDA is 52% higher at $4.2 million. We have 30% more sites in the estate on average this quarter compared to Q1 last year, and PBNs are up by 26% in line with our expectations. If you can flip to slide 9, please. The UK has delivered a good Q1 performance of PBN issuance. Revenue and profitability, despite Queensland ANPR being on hold, there is significant contribution from the new territories with growth in PBN issuance up 98%. If you can move to slide 10, please, Mark. New Zealand is also consolidating its first mover status with growth in all leading metrics, and the German sales team expansion is underpinning European growth. Enhanced account management capabilities is delivering first-class customer service and client retention. It's fair to say that the SPZ team is highly focused on delivering growth once again in FY24, and will of course update shareholders and the wider market of our progress again in February of next year. If we can skip to slide 12 now, please. And I'd like to give you more detail on the news, on further news today. If we can go to the next one, please, Mark. Thank you. Perfect. I want to give you further news today on our new territories and potential new territories we're looking at. As I noted at the start of the presentation, given our successful track record, strong technology and operating foundations, we're now beginning to evaluate and explore new growth opportunities in additional territories. While this is an exciting inflection point in our trajectory, I can assure you we will be diligent and cautious. We'll continue to manage our capital and costs very carefully. Encouragingly, our expansion model is low cost with an attractive payback profile. So what does this evaluation include? Well, we're actively researching new territories to find markets where we can create differentiation between ourselves and the incumbent parking management providers supplying a zero-tech solution. Essentially, we want to leverage our IP and a market-leading technology into countries where the regulatory environment allows us to access the driver vehicle license agency database. That means we can access a driver's name and address so we can send them a breach notice in the post when they contravene the rules of one of the sites that we manage. This is how our technology gives us an edge on the competition, where we issue notices by technology rather than by hand or by human intervention. So what territories are we prioritizing? We already have identified a number of large markets in Europe and North America where we can access local DVLA or driver vehicle license agency. And we're working through the process carefully in order to maximize the opportunities we go for. After carrying out our territory due diligence and we identify the market as being a good strategic fit for us, we are able to move quickly because we can deploy our industry-leading technology, utilize our deep domain experience, and execute the plan. If we can go to the final slide now, please, on slide 13. So in conclusion, what can shareholders and potential investors expect from smart parking in FY24? Well, after last year's record results, we have good momentum with 25% revenue growth in Q1 and a strong pipeline of new opportunities in multiple territories. We will continue to progress towards our 1,500 sites under management organic target, which we now expect to achieve 6 months ahead of our original plan. However, that's certainly not the end game for us, especially as the total addressable market is 140,000 sites. As I've said before, we feel like we're at the start of a long growth journey. Germany is a key focus for us. It's our largest single market with 90,000 sites. It does take time to build the team, embed the processes, and find our operating rhythm, but we're certainly there now and we're in full growth mode. We will continue to explore new markets in North America and Europe, and will maintain discipline when considering new acquisition opportunities to supplement our strong organic growth. With our balance sheets and positive cash flow, we're well capitalized to take advantage of organic and inorganic opportunities as they arise. So in short, we'll continue to build our track record. We'll continue to focus on the disciplined execution of our growth strategy, which has served Smart Parking, our shareholders, our employees, and of course our customers so well. So Mark, that really concludes my presentations, I'm very happy to answer some questions or take questions from people watching or listening.
Thanks, Paul. I might just kick it off. I'm just going to leave this thank you slide up here just if anybody wants to note down email addresses and stuff there. Just, one question for me. The 90,000 sites in Germany, and you've talked a lot about Germany in this presentation. In terms of penetrating that market, are you dislodging incumbents for the sites that you're taking on, or is it a relatively new offering to the German market, the way you do things? So if you approach, I don't know, a large shopping center group or, a large office park to say, we can, take this internal, possibly manual process or some kind of tech that they built hodgepodge themselves off your hands for a complete system that has a proven track record that you can point to in, the UK, Australia, wherever. I'm just trying to understand, how the penetration of that German market is going to work in, to get you from this 1,100 sites to the 1,500 sites, of which I'm guessing Germany is going to be a key component of that.
Yeah, Germany will be a key component. I mean, there's still strong growth in other markets as well. Let's not forget the UK, which is growing very nicely, as well as New Zealand, which is also today. I mean, I think if we just flip back a couple of slides, Mark, if you go to slide, keep going to the slide, next one, that one. Ooh. So forward again. That's it. That's the one. All right. So we can see here, obviously, the growth in sites, and when we released this deck on the 10th of November, we're at just under 1,200 sites. But there's a growing contribution from, you're right, from Germany and New Zealand in particular, and that's what we're looking to add is those new territories, whilst the UK continues to do what it does. However, what are we dislodging competitors? Most of the time, no. So in Germany, the number plate recognition technology, whilst it's not new, it is new to the parking marketplace, and it's relatively new to be able to access the DVLA in Germany. All right, so that has not been common practice until 2 or 3 years ago. Okay, when we really found out about it and understood, and we thought, okay, right, how do we go about entering this market, you know, in the best way possible? And the fact that we proved ourselves by opening up New Zealand and Australia, you know, we felt we had a good level of confidence. We found some good people. We were going to go for it. But really, you know, we've got a very disciplined sales approach that we've developed in the UK, and we've transported that to the new territories, and we've got it working in Germany. Now, but most of our salespeople, when they go to a site, there's either nothing there, as in no parking management operator on site at all, or if there is, it'll be a manual operation. And they have these things called a parking disc, which is kind of like a cardboard clock, right? And what you do, when you arrive at midday, for example, you set the cardboard clock to 12 o'clock, then you put that on your dashboard, and then when the warden comes around and looks at, oh, you arrived at midday and it's only 1 o'clock, so you're here within the 2-hour time limit. Well, of course, it's an honesty system, really. So dislodging that with a technology-led solution that the customer can get real-time analytic data, and so they can understand what's going on in their car park, which of course is an extension or part of their business. You know, we can provide them with the hub, we call it the hub, which is the customer portal, which says, okay, how many cars came and went today? What was the average dwell time? What was the busiest time of day? I can manage my whitelist on there. I can submit cancellation requests if we've given a ticket to a particular customer that they want to look after, you know, those sorts of things. And this is the difference in what we offer versus the kind of zero tech solutions that we see a lot of in Germany, and we see an awful lot of in New Zealand, right? In New Zealand, we're offering often dislodging like a tow truck operator who would send the truck around, you know, once or twice a week to see if anyone's overstayed. So those are sort of things we're dislodging. Obviously, the UK is slightly different; it's a more mature market. But even there, you know, 50% of what we install every month, or win and install every month, there's no prior operator. So, you know, we're still at the early stages of penetrating this market, you know, across all the territories we're in. And we're excited by, you know, the new territories we've opened, in particular New Zealand and Germany. You know, there's a big opportunity there for us, and we're working hard to capitalize on it.
Okay. So I think somebody new to the story, Paul, so just and it might actually be worth just refreshing everybody's memory, a bit of a first principles one on the revenue model for, you know, the service that smart parking offers. So maybe just a quick 1-minute overview of, you know, you move into a shopping center car park, office car park, plug in the system, you know, how does it work from a revenue perspective then for smart parking?
Sure. So obviously, if we start right at the beginning, so we're a technology-led parking operator. So if people are new to the story, if you think of, in particular in Australia, if you think of parking operators like Wilson Parking or Secure Parking, they're what we would call a CBD-centric parking operator who focus on, you know, they'll get a lease on a parking building or a multi-story car park in the middle of town. They'll install technology, they'll put the boom gate solutions in where you have to pull a ticket and all that kind of good stuff, right? Which is very expensive to maintain, but that's their model, right? We focus on free flow car parks. So again, if you think about Australia, if you go to a Coles car park or a Woolworths car park or Bunnings, something like that, it's all free flow. There's no barriers in place. You have to pull a ticket or anything like that, but it's a time limited car park. Same for McDonald's or any other kind of fast food outlet. So these are sorts of customers that we manage their car parks for. And we put the number plate recognition cameras up, we watch cars come and go. Now, as part of the bid, or the excuse me, the value proposition to the customer, or the pitch, if you like, is we go to the landowner. It could be a retailer, property agent. We do a lot of work with Savills, for example, you know, fast food outlet. We go to them and say, hey, listen, we'd love to manage your car park for you. I will provide you all of the technology, the number plate recognition cameras. I'll provide you the signage. I'll provide you with the payment solution if it's a paid car park. So that can either be pay and display machines, or it can be a pay by phone solution. I will provide you with a customer portal that you can see exactly what's happening in your car park at any one time and give you real-time data and real-time analytics. and I will manage the breaches as well. So we will send all the breaches. So the customer then gets that equipment. You know, we install that at no cost to them. So we take the CapEx. We obviously maintain ownership of that equipment. The average CapEx installation is around about 10,000. We look at about the UK because our biggest operation is around about £10,000. So in Australia, so 18 to 19,000 Australian. And we tend to see a payback through obviously the breach notices that we collect, and obviously we bank. We tend to see a payback of somewhere between 6 and 8 months on that original investment. Average contracts are 3 years. We have a greater number of contracts going to 5 years these days, particularly in the newer territories where we can sort of push a bit harder. But the average today is still at 3 years.
And then regulatory question, is there any regulatory changes in the pipeline or rumours for some of the other states outside of Queensland? So, you know, Queensland have, you know, I guess maybe first one out the gate to, you know, make noises of changes or decide what they're going to do. And, you know, as all governments like to do, they tend to watch what everyone else is doing. You know, right. In Victoria, where you are, you know, state government there, any noises coming out of the industry or the minister responsible or the department responsible?
So I guess before I answer that one, I think it's important that we identify the differences between the territories, right? So if we look at the UK, Germany, and New Zealand versus Queensland, those first three, UK, New Zealand, and Germany, they all have what you call a private parking code of practice, right? There is a rules of engagement in place that's set in legislation that means that you have to, that as a private parking operator, we have the ability to access the driver vehicle license agency database, okay? But we have to be accredited, we have to be part of a industry body, we have to agree to be audited 4 times a year. So there's lots of rules that go with it, right? But those 3 areas have that regulation already in place. Queensland was a bit different, all right? In Queensland, we can access the keeper details via a legal third party, a lawyer, right? But there's no actual parking code of practice in place. And we identified this in our due diligence as a potential risk, but it was worth having, opening the business and having a go. And I think it's important that shareholders and people listening to this really understand that the potential for contagion is incredibly low, right? It's non-existent in those other 3 territories. However, in Queensland, we only operate in Queensland and Australia today. We don't operate in Victoria or New South Wales or other states. The reason being is that we can't access keeper details in those other states in the way that we want to, okay? So it's very important to understand that if we're managing someone's car park and we watch cars come and go, if a car arrives on a Monday and in a 2-hour stay car park and stays for 5 hours, if they receive a parking breach notice, you know, by the Friday or early the following week, the chance of them paying that breach notice is very high, right? In other states, and it's a big part of what we do, the speed of which you get the ticket to the motorist is very important, so that they understand, okay, yeah, I did break the rules, I'll cop that, or I'm going to appeal, or I'm going to complain in some way, or try and get it cancelled. But we start the conversation and it happens quickly. In other states, so for example, South Australia and WA, all right, we can access keeper details, but through a court order. So that means that if we open there, the ticket wouldn't get to them for maybe 4 or 5 weeks. That's not going to work, right? And our model won't work in that environment. So it's very important the speed, not quite real time, but you're getting the contravention through to their motorists in a quick space of time, rather than over several weeks or even a month, right? Because you'd issue lots and lots of tickets and not get paid. So it's not a good business to go into. Queensland will understand more in the next couple of months, I believe. We've done a consultation there. I've had meetings with the minister. It's very frustrating, but we have to also put it in context. All right, the company was that part of the business was loss making. Okay, it was less than 5% of our revenue. It would have probably been break even some part of the first half of 24, maybe early part of the second half. But also we also have to put it in context that, you know, there's been no contribution from Queensland since February. and yet we're still 25% up in revenue and 50% up in EBITDA. So, you know, the other areas are growing very strongly. We've covered that gap rather quickly, but we need to just focus on other territories now until we get the nod from Queensland as to which way they're going to go. And it might be that we have to take our cameras out and go elsewhere, because don't forget, we always own those assets. So we can redeploy those to Germany, to New Zealand, to the UK, or wherever it may be, or Scandinavia, where we're very interested in right now, or parts of the US, which again are interesting to us. So frustrating, yes, but one of those things we just have to keep working with the government and then move on when we can.
And then maybe another first principles question as well. How big does a car park need to be to kind of, be attractive to you? Is it, one with 100 spaces, 200 spaces? What's kind of too small? What's kind of, going to make it, for the customer's point of view, that you're going to be managing on behalf of, and for you as well?
The size is kind of irrelevant, right? And what's important is where the car park is located, right? So what's close to it, and what are the reasons as to why there would be abuse of those parking spaces? Yeah, is it next to a transportation hub, bus station, train station, wherever it may be? Is it close to entertainment venues? Is it close to a centre of town? Is it close to where there's going to be lots of footfall? A great example I like to talk about is a site in the UK which is a pub car park, right? There's 11 spaces in this pub car park, and it's in the centre of a town called Solihull. People who understand, the UK might know Solihull, which is very close to our office in the UK in Birmingham. And I know this place very well. I'm ashamed to say, but I know there's only 11 spaces. And when the team said to me, "Hey, we're going to install the system here," we've been seeing the landlord. They're really keen. He's fed up with all the abuse he gets, and we want to put a system in. And at the time, I thought, pretty small, but I get it. It's sort of centre of town, understood. And what I'd forgotten and not seen, and what the surveyor pointed out to me was, there's a hospital that's 5 minutes walk from there, right? Hospital parking in the UK is frightening. It's super expensive. It's always busy, and people don't like missing appointments. If miss appointments, it's hard to get another one, right? And that site, 11 spaces, will average £3,000 every month in receipts. It cost us probably £6,000 to install. All right, so it's an unbelievable site, and it's a 3-year contract. And the landlord's happy because his customers, his regular customers who use the restaurant or the bar or whatever it may be, they'll park and they'll go straight in when they're ordering their food or drinks. We put a tablet on the bar and also at the entrance to the restaurant, and you can enter your number plate to exempt you from getting a ticket. And we do that a lot of our customers. Hotels are another big one. When someone's checking in, the receptionist will say, "Would you mind putting your details in for how many nights you're staying?" And that's what our technology will do. And then once you've captured that data, that guest won't get a ticket. So coming back to the size question, it's not a question of how many spaces there are. It's a question of where it's located and what the reasons as to why there's pressure on those spaces or why they're being abused.
And then, well, we're slightly over time, Paul, so I'm going to squeeze in one last question, if I may. One from me. The US market, obviously, we're talking 50 states. Every one of them issues their own driver's license. I know from living there. Is it similar to the US, or sorry, similar to Australia, where Queensland you have access to the registry there, South Australia, WA you don't? It has a kind of a convoluted way of getting the tickets. But I'm just kind of thinking, we have access to all the information we need, but it's in Rhode Island, Montana, which is 2 million people. Or is it actually we can access this information at a state like California, Florida, Texas? I'm just kind of trying to, is there uniformity among the states? Generally, it doesn't happen in the US. They like to do everything differently. But just in terms of that US market, how similar it is across states?
Look, we're actually doing quite a lot of research in the US right now, right? You're right, Mark. Every state is different, and of course, within states, cities and counties can be different as well, right? So it's quite an interesting marketplace, and requires, before we say, right, we're going to go for this sake and, you know, go all in and spend some money and set up. We've got to be right. We've got to be sure, okay, that this is going to be right, and there's nothing going to sort of come out of the woodwork at us. There are a couple of states that are very interesting, all right, and there is some precedent already set, but there's also some legislation already set. In particular, Florida, and which is interesting to us because it's a high populous place, lots of car use, quite transient because it's a holiday maker type environment. So those sorts of things are very interesting to us, and there is legislation in place that allows private parking operators to access the DMV and also issue these parking breach notices. So Florida is probably, you know, our research not finished yet, but when I suspect that'll be first cab off the rank. Tennessee is also very interesting. Again, there's legislation in place that will allow us to access DMV, and same in Texas. So the only thing we're trying to understand better is that the county by county are there changes. We're not quite there yet with that piece of research, but we're working hard on it, and we expect to have some better information soon. But the US is, no, it's a big market. They're well known for their low tech solutions in parking in particular. They don't adopt technology very quickly, but we are seeing it happen. You know, in particular, pay by phone or phone payments is interesting right now. So I do expect to be doing something there in the medium term. I suspect there will probably open up somewhere else in Europe before that. I suspect a Scandinavian country, some really interesting work being done in Denmark and Finland right now. And that is a real interest to us. So we've got a bit of a pipeline sort of lining up. But, you know, we also want to make sure we do things right. You know, we want to make sure we meet our KPI of the kind of payback. That 4 to 6 months is very important to us, and the cash flow that we're driving. You know, as I mentioned during my presentation, you know, we're able to do lots of other things in the last 12 months. You know, 800k buyback, you know, 3 million shares at an average of 23 cents. We pay for out of cash flow. We bought two more acquisitions. We've done 3 acquisitions in the last 2 years. We've opened up more territories. We've paid down our coronavirus business interruption loan out of cash flow, and all this done in the last 12 months. That, you know, we started off with 10.8 million, and we did all that work, and we spent $6 million in capex, and we ended up with 10.7 million. So, you know, we're able to fund all this, but of course we want to keep doing that. So by backing the wrong territory or jumping too quick and not really doing our research would be foolish, because we want to keep that growth momentum going. But we are focused. We've got great technology. Technology is what separates us from lots of people, and a huge amount of competition in every territory we're in. So I guess that is our defense to the market, but also people and service and lots of other great things that we do. So hopefully I've got that. I managed to get that across in my 30 minutes or 38 minutes as it is now.
Yeah, I do want to leave it there because we have stolen enough of your time, Paul, and that's why I put up the this thank you slide. We didn't get to all the questions, so if you do want to email Paul anything that we didn't cover today, apologies. There was just far too many questions for the time available, and we will endeavor to have Paul back on in 2024 at some stage. And yeah, we'll get an update on all things smart parking then. Paul, thank you very much for joining us this morning.
No worries. Thanks, Mark. Thanks, guys. Appreciate your time.
Thanks, everyone.